Did you know that your life insurance policy could be the key to unlocking funds for a major expense? Today, we are diving deep into the world of whole life insurance loans, an often overlooked financial tool that can provide immediate access to cash when you need it most. When you think of life insurance, you might picture a safety net for your loved ones after you're gone. But if you have a permanent life insurance policy, such as whole life, universal life, or indexed universal life, there's much more at your disposal. Unlike term life insurance, which has a set time limit and doesn't accumulate cash value, permanent life insurance does. And as your policy matures, this cash value becomes a powerful financial resource. Here's how it works. As you pay your premiums, a portion of that money goes into a cash value account. Over time, this account grows, and once it reaches a certain level, you can borrow against it. The amount you can borrow and the terms are determined by your policy. But here's the best part. The funds you borrow are tax-free. Imagine needing money for a new furnace, medical bills, or any other emergency. Your life insurance policy could provide the cash, no credit check required. But there's more to it. Let's say you can't repay the loan right away. That's okay, because repayment is often optional. However, if you don't repay, the death benefit, the money your beneficiaries receive, will be reduced. It's a trade-off, but one that gives you flexibility in managing your finances. This is why understanding when to borrow from your life insurance policy is crucial. Policies typically start building cash value in 2 to 5 years, and by around 10 years, that cash value might be substantial enough to borrow against. Insurance companies will fund the loan using your cash value as collateral, ensuring that your policy remains intact even as you borrow against it. Now, let's talk about interest. Like any other loans, life insurance loans come with interest rates, often ranging from 5% to 8%. This interest can be fixed or variable depending on your policy. But here's something interesting. You don't have to worry about strict repayment schedules. You can choose to repay the principal periodically, pay only the interest, or even let the interest accrue. However, it's important to note that unpaid loans reduce the death benefit, and if the interest grows too large, it could put your policy at risk of lapsing. So, when does a life insurance loan make sense? If you find yourself in a situation where you can't qualify for a standard loan or need cash immediately, a life insurance loan can be a valuable stopgap. It's quick. There's no credit check, and you're essentially borrowing against money you've already saved. Even if you're approved for a traditional loan later, you can use it to repay the life insurance loan. But what if you're struggling to keep up with your policy's annual premium? Don't let your policy lapse. A premium loan can keep your policy in effect, ensuring that the death benefit remains greater than the loan amount. This way, even if you can't repay the loan, the policy can still provide for your beneficiaries. And here's something that might surprise you. Life insurance loan can be more competitive than other types of loans, such as personal loans or home equity loans. With no repayment dates or renewal dates to worry about and often lower interest rates, life insurance loans can offer financial flexibility without the burdens of traditional loans. However, it's not all rosy. There are disadvantages to consider. If you don't repay the loan and interest, your policy could lapse. If this happens, the IRS may treat the loan as income and you could owe taxes on it. Plus, unlike most loans, life insurance loans usually don't have a timeline for repayment. So it's essential to make regular payments to avoid accruing significant interest. Now let's talk numbers. The amount of cash value you can borrow depends on the rules of your insurance company. Typically, you can borrow up to a certain percentage of your policy's cash value. It's important to check your policy's illustration regularly to see how much cash value you have available. For example, your surrender value is the amount you'd receive if you surrender the policy today. The loan value or the maximum you can borrow is usually around 92% to 96% of the surrender value, minus any existing loans. But what if you're thinking about cashing out your whole life insurance policy? If your goal is to leave money to your loved ones, you might want to reconsider. Cashing out means you'll receive the money you've paid into the policy plus any earned interest. However, taking a loan or making a withdrawal while leaving some funds in the policy could be a better option. This way, the policy remains active and you have the opportunity to restore the full death benefit by repaying the loan. If you're wondering how long it takes to borrow money from life insurance, the process can be relatively quick. Depending on the insurance company, it can take anywhere from 1 day to 15 days to receive the funds. So, should you pay back your whole life insurance loan? The short answer is yes, if possible. Remember, your loan is using your cash value as collateral. If you don't repay it, your policy could lapse, leaving your beneficiaries without their inheritance. And if the loan amount exceeds your policy's cash value, you might find yourself owing taxes. A life insurance policy can be a valuable source of funds when unexpected expenses arise, but it's not a decision to take lightly. And before you make any decisions, consider consulting with a financial advisor to weigh the pros and cons. Whole life insurance loans offer flexibility, but they also require careful planning and understanding of the risks involved. Thank you.